Most of you will be what we call a swing trader. This is where, and this is information I got from Investopedia's website. They say a swing trader is someone holding a position from 1 to 4 days. I look at anything from 2 days to 30 days as being a swing trader. So you're looking for shares of short-term price momentum. So you're ignoring the fundamentals or what we call trying to establish what is the fair value of the share. So you're looking at more the technicals. I'm looking at price trends and patterns, and we'll talk about it in a few slides' time. I'm looking for shares that have the potential to move fast in a short period of time. So as a swing trader, you must be able to act quickly. You see this opportunity come along and you grab it. This is what a swing trader would do. So whereas large institutions don't have the flexibility to move in and out the market because of the sheer weight of funds they've got, you as an individual trader can exploit the short-term price movements and take advantage of that. But saying that, you're not competing with the institutions. I believe in taking advantage of where the institutions are moving the money and exploiting that move. Okay. Then some of you might be looking at becoming what they call a day trader. This is someone who wants to trade intraday. You actually close your positions out when the market closes. You hardly ever hold a position overnight. Most of the time, the guys are using leverage, like with the derivatives, single stock futures, CFDs, the index futures, that kind of stuff. You want to go for small share price movements, small percentage gains, and obviously with being in a leveraged position, that you're maximizing out there. But day trading has been glamorized and things like in movies. But the perception out there is the easy path to riches. But that's really the case. Now, here's a little warning from the Securities Exchange Commission, which is similar to our FSB, our Financial Services Board. Day traders typically suffer severe financial losses in their first few months of trading, and many never graduate to profit-making status. Now, I was reading somewhere about 70% of day traders, 70% of day traders do not make money. Now, that's a worrying factor. So it's a very small percentage. So as I said, most of you will be falling into the category what we call a swing trader, holding a position from 2 to 30 days. Okay. So let's talk about a trading plan. And this is part of developing a strategy. You need to have some guidelines or some in a context. So this is your the broad plan. And obviously on a daily basis, we talk about having a game plan. So we talk about defining your trading philosophy. Are you using more technical analysis, or are you using more fundamentals? Are you using more chart patterns, or are you using more technical indicators, that kind of stuff? So you need to document this, number one. And number two, the more detailed, the better. Okay. Also, a very important part of the trading plan is obviously your risk control. And I always refer to Dr. Alexander Elder's book, Coming to My Trading Room. He talks about the 3 M's. So the 3 M's stand for methodology, trading method. We'll talk about it tonight. He talks about money management. And money management is broken down into what we call risk management. That's using a stop loss. And then also the other side of the coin in money management is the position sizing. Okay. So you need to document this and be specific. What happens in certain cases? What happens if the market goes against you? What are you going to do? Okay. And I mentioned just now having a planning time, a routine. The market closes at 5 o'clock. The futures market, or the index side, runs off until 5:30. Most of the time, you can download your share packages. You have at 8 o'clock at night. But the idea is to have a routine. Go through the today's trades. How did you fare? Did any of these trades get stopped out, or which ones of them you still hold? Have any of them come too near your trade, your take profit, that kind of stuff? So you review that. And then you say, okay, what's going to change? What must happen to change? And then the next morning, you do the same thing again. Look at what's happening in the States, what's happening with Dow Jones, and anticipate what's going to happen on our markets, how our markets are going to open. That's all part of the time routine. I found it useful to maintain what I call a trader's diary. I use an Excel spreadsheet, and I document every single trade I put on. So I'll have my entry price, my exit price, my stop price, and those kind of things. What is the margin required, and work out all these kind of things, and I keep a documented history of that. I go one step further. I actually keep what I call a notebook, and I write down how was I feeling. So I'm trying to establish for myself what is working, what's not working. So did I make the trade more on fundamentals? Did I make more trade on technicals? Was it a tip? Was it just a thumbsuck? Did I go on the on the impulse? Those kind of things. So I can start seeing a bit of a history, a bit of a trend, and I can start focusing on it. Do I make am I more profitable going long? Am I more profitable going short? Those kind of things. So that's where I talk about analyzing your personal trading. How can I improve? So I always believe in using like a funnel approach. When you make mistakes in the beginning, make a lot of mistakes, but learn from the mistakes. And as you learn more about the market, make less and less mistakes. So that's all part of your trading plan. Okay, so obviously it's a working document. It's a work in progress. I find it very useful to document it. Some people talk about a trader's journal. I've got a lot of books talking about that, and that's very, very useful.